For the 14 one-word together problem, we're going to be in page 307 of our journal, and it's going to correspond to page 343 of our textbook. Before we begin, I want to remind you about our 5 basic types of accounts. We also have purchases, but that's not going to relate to payroll. On the extra form side, let's just remember our 5 basic types, categories of accounts. We have assets, we have liabilities, we have owner's equity, we have revenue, we have expenses. I want to remind you how the arrows go, and also remind you that the left side of the T-chart is the debit side and the right side is the credit side. Assets increase on the debit side, decrease on the credit side. Liabilities decrease on the debit side, increase on the credit side. Owner's equity decreases on the debit side, increases on the credit side. Revenue also decreases on the debit side, increases on the credit side, and expenses increase on the debit side, decrease on the credit side. We're going to learn how to journalize payroll and payroll records, so specifically salary expenses today. When you're paying your employees, you're not really going to be making money, so we're not really going to be dealing with any revenue accounts. We're also not dealing with any owner's equity accounts because the owner's not putting any of its own money in or taking any of its own money out. We will be dealing with liabilities. That's going to be our tax payable accounts. And we are going to be dealing with cash, which is an asset, because when you pay your employees, your cash is going to decrease. So we're going to focus on cash, our tax payable accounts, and the expense accounts. So we're going to be focusing on the assets, liability, and expenses arrows. If you see here, we've got a cash T-chart already made for us, and then the 3 types of taxes that are taken out of an employee's paycheck that are recorded in a payroll register. Employee income tax, that's found on those tables, depending on their marital status and the number of withholdings they have. Social Security tax, that's calculated by finding 6.5% of their total income for the pay period. Medicare tax, that's found by doing 1.5% of their total income for the pay period. And salary expense is basically the total that the company needs to pay before taxes are taken out. All of this information is actually found in a payroll register. If you look at this example of a payroll register that's in our book, it's really important that the totals column is completed because that's where we're going to be finding a lot of our information. On the side, on the next page, it describes how the T accounts are affected. So salary expense was debited. Expenses increased on the debit side, so it increased for that total amount. That was before taxes were taken out. That's found at the bottom of this column right here. And then all of the separate types of tax payables have their own accounts. So this is the income tax, Social Security tax, Medicare tax. In this example, they had health insurance, U.S. savings bonds, United Way donations, and then cash. So basically, you find all the totals of these taxes that were taken out from this record. So the total federal income tax amount here, that goes on the credit side of the employee income tax payable. This will go on the credit side of the Social Security tax payable, credit side of the Medicare tax payable, credit side of the health insurance. And then the other, it's really written tiny, but the B stands for bonds and the UW stands for United Way, and those go on the credit side of their specific T-charts. The amount that's actually paid in cash is the amount that's not taken out in taxes. So that's going to be this total. This total is going to be taken out of your cash account, which is represented right here. Cash was, the net pay total. This is the total number of deductions, and the net pay, remember, is found by doing the total income for the pay period minus the total deductions, and that's the amount that's taken out of cash. the 28902 in this example. So we're going to use the work together problem on page 343 in our textbook, and it gives us the following information. It kind of picture this as being a payroll register, and these being our totals that we need to use. So the total earnings gets taken out of the expenses. So expenses technically are increasing. So on your work together problem, your salary expense increases. Remember, expenses increase on the debit side. It increases by that amount. So that $12,600. Then we have a federal income tax withheld. So if we find our income tax payable, that's going to be credited because liabilities are increasing. That needs to be paid when taxes are due, but it's not paid yet. So it's a tax payable of $1,386. We also have a Social Security tax withheld, and that's going to go in the Social Security tax payable. That's $819. And Medicare tax of $189 is going to go into the Medicare tax payable T-chart. You're probably wondering why they didn't give us a cash amount. But remember, the cash amount is the actual net pay that you actually pay to the employees that is found by taking the total expense and subtracting all of the different taxes that are taken out. So we actually have to do that math of 12,600 minus 189 minus 819 minus 1,386. And we get $10,206. That's what needs to be credited in the cash account. All of these credited amounts should add to this salary expense amount, because remember, if you're going to debit something, then there needs to be a credit for an equal amount. So all of those are going to constitute for the credit of that equal amount. We can just check that out real quick, make sure. So 10,206 plus 1,386 plus 819 plus 189 should give us the 12,600, which is on our salary expense account. So that's okay. Now we need to journalize these in the cash payments journal. The reason it is allowed to go in a cash payments journal is because cash is being paid or going down. It says in the textbook that the date is for the pay period ending July 1st to 15th, so therefore it ends on July 15th. So the date is July 15th. It says to use page 15 in the cash payments journal. And then we need to record these effects on these T-charts into this cash payments journal. Remember that, well, it really doesn't matter for a cash payments journal. For a general journal, the debited account goes first and the credited accounts go second, and they're indented. We don't have to indent anything in a cash payments journal, but let's still put the debited account first. So salary expense will go first. And then we just list everything except for cash, because in a cash payments journal, it's implied that cash is used. So we'll just make that note in this column over here. So we list all the other types of tax payables. So we have employee, income tax payable, Social Security tax payable, Medicare tax payable, It says in the textbook that this is check number 455, so under check number 455 covers that payroll. And we need to debit salary expense $12,600. It's not on account, so it does not go in the accounts payable debit. These are accounts payable, but you're not debiting them. They were being credited, so that's why those values don't go in there either. They're going to go in the general credit. The cash credit amount is also going to go on this first line. The cash credit amount was that $10,206. And then we need to put all of the credited amounts for these three accounts. So employee income tax payable was credited $1,386. Social Security tax payable was credited $819. And Medicare tax payable was credited $189. And that concludes the way in which we journalize a payroll when you're dealing with salary expense, because cash is related